This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. We've got a fun show for you today. We have a gentleman who is from Indianapolis, and you guys know how much I love Indy. A lot of the stuff going on out there, and I have featured folks and activities there that are that go on in Indianapolis because I think it's a good market. Well, he's a guy who has been involved in wholesaling and rehabbing houses and finding good properties and doing a lot of the things that are really critical to finding those good investments. So I'm real excited about today's guest. His name is Steve Lawson, and he's the president of Indy Home Vault, a real estate investment consultancy in Indianapolis, of course. Prior to the founding of Indy Home Vault, his current company, he spent 10 years designing retirement income plans as a CFP, so Certified Financial Planner, RFC, and CSA, with advanced education in estate planning, tax planning, risk management, and distribution of IRA and 401k plans. When the tech bubble burst in 2000 and 2001, Steve realized that real estate was a much better option for most of his investment clients. So he started advising them on how to invest in real estate instead of the annuities, the stocks, bonds, and mutual funds that he had been working with in the past. In fact, he even ended up letting all of his security licenses expire and focus 100% on real estate investments. In the past 16 years, he has worked with and helped many investors acquire rental properties, fix and flips, and this through the acquisition of single-family and multifamily homes, turnkey, and distressed properties. More recently, he's helped investors find ways to earn strong real estate investment returns without direct property ownership. So I'm sure he'll expand more on that. Wow, great stuff happening there. Steve, welcome to the Old Dogs REI Network.
Thank you. Glad to be here.
Man, we're glad to have you on. You have a great background, and I love your story of how you started in financial planning, working with people to put their their retirement plans together and their lifelong investment plans, and how you just shifted into real estate investing. I mean, it's a fascinating story. Why don't you just kind of give us your background? Where you came from and how you kind of moved into the places you went and ultimately ended up in real estate.
Well, sure. I've lifelong Hoosier, born here in the state of Indiana. I've lived in Indianapolis for the last 25 years. And when I started my career, I'd had a degree from Indiana University in accounting and finance. And then I went into the finance side of things and became a financial planner. And like I said, my area of expertise was actually retirement income plans, primarily for seniors. And so I jokingly referred to myself as the nerd in the back room. I actually trained because my job was to put the designs together. I worked with about 1,000 different financial advisors across the country, and when they had a senior client that that needed a retirement plan, they would contact me and say, "Hey, Steve, how do we put this together?" And so most of my job was in the back room saying, "Okay, well, if we do this percent here and we design this here, we put this here, this will give them the most income with the least amount of risk, the lowest taxes, and make sure they never outlive their money." So that was my job for about 10 years.
Interesting. Wow.
Yeah. So while doing that, as you mentioned, I became a certified financial planner. RFC is a registered financial consultant, and the CSA is a certified senior advisor. Because again, most of the clients I was working with were seniors. And so that's what I was doing for 10 years. And remember, the market in the 90s, incredibly strong market. We were still using a lot of fixed rate vehicles just because they were lower risk, but a lot of people were excited about the market. And by 1999, they'd forgot that it goes up and down. They thought it just always went up.
Yeah, funny how it does that, huh?
Yeah, they'd forgotten that by then. And so then 2000 and 2001 kind of reminded them that the market does go both ways. And the tech bubble burst, and a lot of people lost the part of the money that was in the stock markets. And so they were coming to me trying to figure, hey, what do we do now? We had however many dollars, and now we have half as much. We can't pull out money and live. We're not sure we're going to have money until the day we die. We're not sure. We don't want to outlive our money. And the people who were in fixed rate products, the principal was protected, which is great, but they'd gone from 7 or 6% interest down to 3% interest. And so they're living off the interest. Their income had been cut in half. And so they're trying to figure out, hey, how do we get enough income to survive on? And so that's really where I hate to say stumbled across real estate. I'd always liked real estate personally, but I'd not been recommending it to my clients until then. And so I started looking at rental properties and saying, well, look, we're getting 10, 12% returns, income stream from these rentals, which is way better than any of the fixed rate products. Plus, over time, rent tends to go up. So your income is going to automatically increase over time with inflation, with cost of living. Not only that, but not only does your principal not get eroded, but it will appreciate over time, the longer you have it. So it really solved several of the challenges we were having with the fixed rate properties, or the fixed rate products and the market-based products. And so it was just a better solution for my clients. So I made that transition then to advising people on how to invest in real estate. And like you said, gave up all my securities licenses and moved forward.
This is really interesting to me. For one, I thought it was really interesting that, first off, you were sort of the guy that the other guys would go to for specializing in those that were seniors already. So I would assume that most of them are dealing with guys in their 30s and 40s, or maybe even in their 20s, that have a longer period of time, right, for wealth acquisition and so forth. So you were really a specialist in sort of the short timers, so to speak, those that didn't have as long a time period. Is that right? I mean, that's kind of your specialty?
Right, that's correct. And so the way I look at it is you've got different phases throughout your life. At some points, early on, you're trying to create wealth, whether you're setting money aside or you're aggressive, you're trying to create your nest egg. And then once you hit a certain age, usually around 50 or so, it's more about preserving it and getting some growth out of it. But then when you retire, you just want that nest egg to be able to pay you without you losing that principal. And so, my focus at that time was really that last part where, okay, you retired last month. This is your nest egg. You're never going to add to it. This is it. How do we make it last your entire life? Make sure you never run out and maximize your current income.
And the other part of that is, it really impressed me too, is the fact that you seriously looked at a solution to their problem. Now, I mean, not to say that, that there are the folks out there, the financial planners, that don't do that, but generally, I think they look within their little box that they know about, right? All the the instruments, the investments that are sort of traditional that you can work with, and maybe you're going to squeeze 3% out of it. Maybe you're going to get a little bit more, but if you go higher risk, run this, and whereas you kind of went outside the box. I mean, I don't know that many financial planners that would say, hey, buy yourself a duplex, I mean,
Well,
it seems very untraditional there.
Well, it is, and it wasn't just a little outside the box. It was a lot outside the box because if you have a securities license, you're not allowed to recommend real estate.
Are you serious? Really? You're not allowed to recommend it?
Your financial advisor can't say, hey, yeah, you got to go pick up a couple duplexes or multi-unit. You'll get a good return off that. They can't do that. And so when I looked at it and I made the decision that, this is really better for the investors. It wasn't that I wanted to give up my securities license. I had to.
Wow. Okay. I didn't realize that. That is really telling right there. My goodness. Looking at real estate, it sounds like, if I get your story right, that you were already an investor yourself to a certain degree. Is that correct? Or were you like investing?
Yes.
Or did you have friends, or you were doing it personally, right?
Yeah, I'd already invested in real estate myself. And here's the funny part is early in my career, as I was just getting right out of school, even I'm sitting there thinking, okay, I'm going to make money so that as soon as I have enough money, I can start investing in real estate. Here I am telling people how to invest in the market, but so I can make enough money so I can go invest in real estate. And that was kind of, I was one of my aha moments is I want to be in real estate. I just had to figure out how to get there.
Oh, I love that. God, that is really interesting. So you knew what was really going to produce for you for the long term. You're in a business where you're kind of telling other people, other things. And at the time that you were doing it, of course, there were some good investments out there, and people could get, 10% CDs and different things where they could, they could move. But that's very, very interesting. And what kind of properties were you investing in at the time?
Again, I did just a little bit, but a single family home.
Got it.
Yeah, I still have the first one. It's almost 20, going on 25 years, a little bit shy of that. The first property I have, and I've had the same tenant for the last 13 years.
No way, really?
Yeah.
Are you managing your own as far as property management?
Yeah, yes. And it's going, again, when you have one tenant for 13 years, it's pretty easy. But I got some others, and I do it myself right now. I don't recommend that to most of my clients, but I do it myself.
To the faint at heart,
Yeah.
Yeah. That is very cool, Steve. That's really neat. A lot of people just would have thrown up their hands and kind of said, well, you just have to learn to live with less. And, this is what the way the market is now. Instead, you really tried to solve their problem, which I think is admirable. And that's great that you say, hey, I'm earning 12%, whatever you were at the time on this investment. Why don't you guys do it? Okay. So it's real different, when you're talking to somebody over the phone and they're saying, okay, buy this annuity or buy that. Now you're helping them to actually buy properties. So that's kind of like changing your whole thing. Did you get a real estate license, or did you just try to direct them on sort of how to become a landlord and a property owner?
Yeah, I did get my license for a while because at the time I didn't realize all the different ways you could be involved in real estate. And I just knew how to identify a good return in real estate and then get compensation by helping them buy an investment property. And again, it was pretty easy, because of their pain. Again, 2001, 2002, like, man, I'm getting 3% on my entire retirement income. What do I do? What do I do? Is there any option out there? Well, here's one over here. Try it with a little bit, see if this works out for you. So maybe they dabble in real estate for a little bit, and after a few months, they say, well, it's paying me more and it's working fine. Let me put a little bit more in it, And so that's really how I approached it, was just, the people who were really feeling the pain of the market or the low interest rates, had them, I kind of showed them what I was doing and had them kind of start dabbling in real estate a little bit, and they just grew more and more comfortable with it.
Was that a little bit difficult for them in that, they just lost half their portfolio? And so now you're saying, okay, take out a chunk here and put it in this area. I mean, were there people that are going, no, I don't want to touch it anymore?
Oh, absolutely. Yeah. A lot of people's like, oh, no, it's at the bottom now. I've got to wait for it to come back up. And once I get all my money back, sure, then I'll go invest. Okay, well, that not always the way it works, but so some people were very resistant, and obviously some chose not to move forward with real estate. But others, the market isn't working for me, and I've got to find another solution. And so they were more open-minded.
So, okay, so let's say I'm that person. Okay, Steve, I want to do that. Now, where do I begin? How are you directing them at that point?
Basically, I was just doing market research and identifying properties that had the potential to provide them with a good return. At that time, I was really only looking for about a 9% return was what I was targeting for them. A little bit more conservative properties. And so, again, these are people that are coming from ultra-conservative fixed rate products. So I was looking for more conservative rentals. So as long as we could get expectation of a 9% return, I would show them a property that would have that.
So give me a more conservative property. What would that be? Would that be like more of a B class property as opposed to a C class?
Yeah, B plus property where you're going to be in a good part of town. Appreciation. Again, this is Indianapolis. You're never going to get phenomenal appreciation, but you're going to get you get some. But again, just a lower risk investment as opposed to hey, we can get these properties over in this part of town and we can probably get you 12 to 14% if everything goes well.
Right, right, yeah.
And so I was conservative enough. I'm like, no, let's not try those. Let's just stick with these. And it was I didn't know the term at the time, but it was almost turnkey, where it's like, okay, hey, here's the property, here's a property manager, and here's what they're able to get in rent. And
you were like turnkey before there was turnkey, it sounds like.
I did, yeah. And turnkey just from the standpoint of here's the property, here's the property manager, here's what it's going to look like, and here's kind of put it all together in a package more or less. And so here's what you'll be getting going forward.
So you had to find them a good property manager. I mean, that's a hard task in itself.
Yes.
Not to say that they're all, bad, but I mean, it's getting one that you can really count on because they're managing now this person's asset, to a certain degree, right? Because the person's at home, they're not generally managing it themselves, I would assume, right? Most of them have property managers.
Yeah. And I tell every one of them, you do not want to manage this yourself. Get a property manager.
Gotcha. And was that an educational experience for you? Because you weren't using property managers for your properties, right?
Correct. So there were a couple of property managers in town that kind of had a turnkey approach to their property management, and so it made it easy to put that together with the property. So it was just finding a property manager that had that kind of package put together already.
Okay, so these were already rehabbed properties. Did they have tenants in place too, or did you help them find tenants?
Most of them already had tenants, or they were either they were rent ready or they had tenants in place. One of the two.
Gotcha. Okay, so this was back in the 2001, 2002, right?
Yeah. Basically, a 2002 to 2006 range. For those yeah.
Gotcha. So, sales were brisk, a lot of, I mean, there was, at least, in the national, economy, there was, all kinds of people are buying real estate left and right, but then you're approaching 7 and 8. So how did your folks do when that recession hit?
They did fine. They just had to constantly be reminded, don't panic. Right. And so you ask them a simple question. Why did you buy this real estate? Because you told me to. Well, yes. And why did I tell you to? Because you wanted income. Is it producing income? Well, yeah. I said, then keep letting it produce your income. And so the only ones that had any issues were the ones who panicked and sold. Most of them said, okay, well, I was trying to collect $800 a month in rent, and I'm still collecting $800 a month in rent. So whether the underlying asset is worth 50 or 100,000 doesn't matter to me because I'm not selling it today. As long as I keep getting my income stream from it, I'm fine. And that was the approach that I wanted them to be thinking. As long as they took that approach and didn't panic and sell, they were fine. And most of them did that. Yeah.
And did everybody have debt service on the properties, or did they buy them in cash?
No, I had them buy all cash.
That was smart.
Yeah, I didn't want them buying. Again, I just I look at the different age brackets. If you're younger, like what I was talking about earlier, if you want to create wealth, use leverage. You've got a lot of time. Use that to your advantage and create wealth. But at this age range, no, I recommended they'll just pay cash, and that way, they didn't have any debt service.
That was smart. Very smart. And what were homes going for back then that you were, I mean, the typical, I mean, there probably was a range, I'm sure, depending on the person, but what was sort of the range of prices that people were typically paying?
Anywhere from 75 to 125.
Okay, so pretty significant. So these are definitely nicer homes.
Yeah.
I imagine at that time too, especially. Okay, got it. You started expanding kind of what you were doing too at the same time. So, okay, so you've got this aspect of your business. You've kind of were phasing out of the financial planning part of it, and now you're moving into really, you're sort of like it's hard to say, almost like a broker / turnkey. You're kind of like more like a turnkey guy almost. Yeah.
Right.
And are you making your money on the sale of the house, or are you? I mean, where how are you surviving because doing this?
Yes. It's now you said phasing out the securities. It was more like ripping off a Band-Aid. I mean, from the
okay,
because I couldn't recommend real estate.
Right.
Yeah.
Okay.
So as soon as I made the decision that I was going to do real estate, less than 30 days later, I was done with securities. So it was a pretty quick transition.
Gotcha.
Yeah, and so and that was in 2002. So in summer of 2002, I was done with securities from then on. And so, like I said, they're buying rental real estate up through 2006, and into 7, maybe a little bit, and then it got to the point where at that time I couldn't justify saying, "Hey, now is a great time to buy real estate," and so. And at the time, I wasn't smart enough to know all the different options that I could have done in real estate. And so I actually took a couple of years and just did actually business consulting.
Oh, really?
For a little bit. Yeah. Just for about 2 years, just because I could I have sold real estate? Probably, but I just, in my mind, I just wasn't comfortable saying now's a great time to buy. So
Gotcha.
I stepped away from it for a little bit, and then came back into real estate. And
what year was that, do you think?
2000, late 10.
Okay, 2010. Okay,
yeah.
Got it.
And when I did that, I also started taking a different approach, because up to, the first time I did real estate, I really did it more as a real estate broker, where I was getting just a commission, for selling the house, just like any other realtor.
Gotcha.
And the second time when I went back, I started doing it a couple of different things. One of them was as a wholesaler. And so I was wholesaling properties to investors, still doing the same thing, but it was just a different approach to getting that property to the investor. And then I also started doing turnkey. So I would buy distressed properties, rehab them, put a tenant in place, and then sell them to the investors as turnkey investments. So I did that for a while as well.
Now you're getting a percentage of the property management fee, or just strictly on the sale?
Well, so I did that. I started a property management company basically to support the sales of the turnkey properties. And in other words, hey, here's a turnkey property. It's been recently rehabbed. Here's a warranty on it. Here's a new tenant in place. Here's the lease, and we manage the property for you. And here's our property management agreement. One turnkey package, and we take care of it for you going forward. And so I put that together, and that's what I did for a while. And I hate to say this, but I looked at the property management business as long as it breaks even, I'm fine. I never expected it to make money, but I had it to take care of the investors, to make sure that they had a good property manager.
Gotcha. So you don't do that anymore then?
No, it took a lot of time to break even, put it that way.
Well, I think the model is unfortunate. It's very difficult, at least from everything I've looked at in terms of numbers and what property managers do, to be able to be profitable, unless you're really in the upper ranks where you're doing, large multi-family properties and that kind of thing. But to me, it seems like that would be a real tough one to really make money on, or even break even in some cases. So
right.
Okay, so you had these folks that you had, and you didn't really interface with those people after, I guess, because it was kind of sustaining itself. They're dealing with their property manager. They're not, you don't really have to be involved, right? The people that you put in early on in 2002.
Correct.
So they're just kind of doing their own thing. Did they come to you ever and say, "Hey, I want more investment properties, and try. I'd really like what this is doing." Was there any of that kind of interaction going on?
Honestly, not really. A lot of them bought between 2002 and 2006. And so, like I said, when I stepped out for a couple of years and came back in 2010, I hadn't talked to most of them in at least 4 years, some of them as much as 8 years. So really didn't talk to them that much. So I didn't maintain communication with them. So they didn't really come back and ask for more.
Gotcha. So you were learning this kind of new space now. You're in wholesaling. You're what you're doing, direct mail. You're doing a lot of things to try to find off-market properties, right?
Correct. That's correct.
In that realm, obviously there's a bigger return. Now, is it difficult to be a wholesaler and a real estate agent or broker? I mean, because when you sell that, it's a different transaction than it is just selling a retail house, right?
Correct. Now, when I stepped away from real estate, I let my broker's license go.
Gotcha.
Yeah. When
Okay.
I came back just as a wholesaler and investor. Yeah.
Gotcha. Were you also flipping or just strictly wholesaling?
Yes. Yeah. So I was over the last 8 years, I've done 3 different things: wholesaling, which I've done pretty much the entire time, and I did turnkey properties for a while. So basically, buying and flipping really to investors, and then also flipping retail. So traditional fix and flip and list properties. So those are 3 things I've been doing the most of for the last 8 years.
Gotcha. And were you building your own portfolio at the same time, or are you doing this mainly again for clients?
A little bit of my own, but mostly for clients.
Gotcha.
Yeah.
So, did you have people then that would contact you and say, "Hey, I want to start investing in Indy. This is what I'm looking for. Can you find me this? And this is the price range I'm willing to go." I mean, are you working with people on that kind of a level?
Yeah. So when I first got started in the wholesaling, I would go out, find a decent property, and I would promote it and try and find a buyer for it. And over time, I built up that buyer's list more and more, and would have more and more conversations with investors. And I really got to the point where instead of me going out and getting a property and just throwing it out to however I could sell it, I was doing more and more of working with individual investor. Like you said, "Hey, I'm looking for a 3-bedroom, 2-bath with a 2-car garage built after 1979, this many square feet. Can you find me one of those in this price range?" Okay, great. Let me go find that for you. And so I started doing more, I called it private placement. Instead of, I didn't send that to a list. I didn't promote it. Once I found that property, I placed it privately with that investor.
Gotcha. Okay. And were they strictly single family homes, or did you get into? I know you're doing some multifamily now. Were you sort of in expanding as well and into multifamily as well as single family?
Yes, I've done both. Quite a few multifamily. They're really hit and miss. It's kind of funny because I've had a stretch of a year or more here or there where I didn't have a single property over 4 units. And yet, the best month of my career was a 6-week period in which I wholesaled 3 separate apartment buildings.
Wow, man. And so it just kind of came and it just depended on availability at that time, I would imagine.
Exactly. Yes.
Gotcha. Okay. That's great. Well, you have had a lot more experience than a lot of folks, I'm sure, out there. I mean, many people are just sort of your buy and hold person. Some people will do, they'll do just wholesaling or they'll do just flipping but you've run the gambit and also had your own turnkey company on top of that. So, and run a property management firm. So you've got a very broad experience. And so, next couple of questions I want to ask you, well, hopefully you can share some of that experience. The first being, what would you look at as sort of your first real big mistake as and I guess I could say as an investor, or it could be the biggest mistake that your clients have made that our listeners can learn from?
Well, when I was providing my investors with turnkey rental properties, so I would buy the property, rehab it, and place the tenants. And I was ultra focused on selling those properties to the investors, making sure that I had a buyer for every property. And in 2014, 15, 16, during that stretch, we were selling 8 to 12 a month of those properties.
Wow.
And so I was so focused on on selling, and having a great relationship with all the buyers and investors. I mean, that's just what I enjoyed, talking to all the investors. What are your goals? What are you looking for? Okay, great. I've got this property that's a fit. And that's what I was doing. I was so focused on selling what was in our pipeline that I was not paying close enough attention to how my rehab manager was doing his job. So all of a sudden making my sales, and I had 29 sales pending, all these houses in our pipeline. I'd sold pretty much every one of them. But I was waiting for the rehabs to be completed, and I did not realize how far behind and over budget he was on all the properties.
Yikes.
Yeah. And it turned out it was a nightmare. But, what I learned is that you cannot manage every aspect of a business yourself unless you have the right systems and processes in place. And I had people in place, and I was trusting them to do their jobs well. And I'd provided some training, but then I moved on and I was getting back to these sales and talking to the investors. And I just did not monitor the rehab step close enough. And so what the listeners can learn from that is, regardless of how you're investing in real estate, take time to list all the things that could go wrong. And with each of those potential failures, determine how you can track data to warn you if you're headed towards one of those failures. And so if I'd put better systems in place to track the rehab expenses, to track the timing, I could have seen these red flags and warning signals sooner than I did and avoided a lot of headaches. So that would be the biggest mistake and what to learn from it.
That's great. And so, just, at least from what I take from that is build systems in your whole business model, right? Systems that hopefully can duplicate from one property to another, but also to have those checks and balances as part of that system, so that you can monitor and hold accountable the people that are not only responsible to you to achieve a certain job, to sort of build that into your model as a means for success down the road. So that's great information. And conversely, what would you say would be your biggest success that you could share with our listeners?
Well, it was the 3 properties I just mentioned. I was able to wholesale 3 separate multi-unit buildings in about a 6-week period.
Tell me about those. How big apartments and so?
Let's see now. Total for the 3 was about 75 units.
Gotcha. Wow.
So it was like 40 units and a couple in the mid to upper teens each, like a 17 and a 15 or something like that. And so part of it, honestly, part of it was kind of luck, finding a seller who wanted to unload 3 separate properties. But part of it was also the confidence that I could find buyers for those properties. Part of it was getting creative with the marketing. So instead of marketing the distressed properties as distressed properties, we marketed them at the price it would take to buy and rehab them. So instead of saying, hey, this 40-unit building, it's got 20 tenants in place, it needs some work done, instead of saying, hey, here's the price as is, we sold it with, okay, here's the total price. You're buying it for this much, and this much is what it's going to take to make everything rent ready and make it a turnkey property for you. And so we were marketing it at, kind of almost as a turnkey, but the work would have to be done after the buyers bought it.
And you're basically saying that you will rehab it for them at this price, or do they have to?
Yes. That's
just an estimate, and they have to figure out who's going to do it.
No, yeah, we managed the rehab for them at that price.
God, that's great. That's great. And this was just you're sending out, maybe you're doing your direct mail or your bandit signs or whatever. I'm not sure what you did to get, to market and find properties. But in that process, as you're looking for mostly single family homes, you had somebody that responded and said, hey, I have these apartments. Was it one person or multiple people?
One person. Yeah, one person. He was an older gentleman, had been in real estate for decades, and he was having some health issues, and he just wanted to get rid of these three, and said, "Hey, can you help me find buyers for him?"
Okay.
So I said, "Absolutely. Let me have a shot."
Oh, that's great. That's great. Wow. That's a nice one to land in your lap. And that was smart in terms of your packaging too. Did you package that to your regular buyers list, or did you look beyond?
Both. Yeah, I marketed it pretty much everywhere. Yeah. So, from my standpoint, what the listeners could learn from that would be, first of all, don't be intimidated by an opportunity that looks big. That's how you make big money. And so, I could have said, "Oh my gosh, I've only sold single family and duplexes. I can't sell a 15 unit or a 30 unit or whatever." But I did. It's like, well, it's the same process. I'll give it a shot.
Exactly.
And so first thing is, don't be intimidated. Second one is, I use the phrase that whoever has the best solution wins. If I had just tried to wholesale those for the current condition, I'm not sure if I would have sold them or not. And if so, I would not have made nearly what I did on them. And so by being creative and having a better solution for the end buyer, a more creative solution, that's what enabled me to sell all three of those in a short period of time. So
now, did the buyers do debt service, or did they pay cash for the properties?
one paid cash, the other two got loans.
Okay, gotcha. So, and you're not used to, or you weren't used to working with folks that were financing properties, or by that time, was that a pretty common part of your business?
It was pretty common. Yeah.
Oh, okay.
Once I got in, at that time I was doing quite a bit with lending. And the funny thing is, you think about the property prices here in Indianapolis. I mean, these properties that were 15 to 20 units were still only $200,000 to $300,000.
Right.
And so I had investors in California and on the West Coast that looked at that and they just kind of laughed, and it's like, well, that's less than my house. Actually, even the 40 unit one, the purchase and rehab was still in the 900,000 range.
Uh-huh.
This guy's like, I live in California and I've got a 4-bedroom 2-bath. That's that same price. You're saying I can get a 40-unit apartment building for that?
Well, that's how when I encountered Indianapolis, that blew me away. I was going, seriously, I did the same thing.
Yeah.
But that's great. That's a great lesson learned too, and I like it how you got creative in terms of your marketing and where you could actually get your contractors in there to give some estimates and be able to market it as a package deal, because especially buyers, if they're out of state investors, the whole thought of, oh gosh, I got to deal with all the construction and all this, and how am I going to oversee that and what have you, but taking that on as part of the purchase price, that's pretty cool. That's great. There's probably pressure on you to stay in your numbers, obviously, but
right.
But still at the same time, it's a smart way to package it. That's great. This next question I'm going to ask is one I ask all of our guests, but I think it's kind of interesting to ask you because you know our audience probably better than most of my guests that I've asked this question of, and that is, for those that are that 50 plus audience out there now, and I'd say I kind of narrow it down to, there are those that are approaching retirement, and so they're kind of looking at their whole situation in terms of, gosh, do I have enough, put away? Am I going to build? What about the longevity issues? What about things like, further off, like assisted living, all these elements that people are thinking about when they're looking at their retirement. And then there's this other group that's already retired. They're already there, and they're looking, both groups though, looking toward real estate investing as a means to be able to help fill that gap and to be able to, help them either through cash flow or a good place to invest their nest egg or whatever it may be. What advice would you give to that audience in from your standpoint, having dealt with the real estate on this multiple levels here? What advice would you have for them, in terms of generating that income or getting that good return that they're looking for?
Well, sure. Well, a couple of things. First of all, since I focused on giving investment advice to seniors for a quarter of a century, which, wow, that really makes me sound old. I do have some advice One of the things, I mentioned earlier how I kind of break it down into the growth. If you're most people under 50, from 20 to 50, you're working and you're trying to create wealth and grow the assets you have. And so that's kind of what I kind of consider phase one. Once you hit about 50, that's where I start being more cautious from age 50 on. And I usually, just recommend not acquiring debt. And I highly discourage anyone over 65 from acquiring any property with financing. So, the first one is not to get tied down with debt as you approach retirement, or certainly are within retirement. The second one is I would encourage you to consider fixed rate returns that are secured by real estate. So, for example, what we're doing with a lot of investors right now is we work with investors who want to earn a competitive fixed rate. We arrange for them to become private lenders secured by real estate that's worth at least 150% of their loan amount. And so if you do that, just make sure it's done right. Make sure the note is backed by a lien and it's filed properly, just like a bank would do it. But that can give you some competitive returns backed by real estate that is safe, and it doesn't have the volatility of some rental properties. And that's a pretty good safe solution for people who are already retired and just want to preserve principal and want income stream.
What kind of returns would you say are sort of current? I know that can change, but
right. Well, and it depends on the risk of the loan, but I've seen anywhere from 6 to 12%, and a lot of that has to do with a lot of what we do are 6 to 8% loans because they're secured by real estate that's worth at least 150% of the amount of the loan. So those are very well protected loans. They're lower risk, and so they've got a lower payout, the 6 to 8%. Whereas we do see some in the 11, 12% range. Those are a different type of loan that are they may be secured by a property that's only worth 110, 120% of the loan amount. So it's still protected by property worth more than the loan. There's just not as much extra protection in those. So therefore, a little bit higher risk, a little bit higher return.
Gotcha. And were you going to say something about the 65 plus group, or did you that's pretty much applies the same, the 50 plus group?
Yeah. So the first thing was just 50 to 65. I would be very cautious about being a borrower, and then above 65, I was recommending I wouldn't borrow at all. And then and those income streams, those are great property or products for someone who's over 65 to be able to create cash flow that's steady. Again, I love rentals, been involved in the rental market for over 20 years myself, but I also know that there's ups and downs. And, and for most of my career, that's not an issue. If you got, a couple properties, you have a good month, bad month, that's extra income, that's future growth. But when you're over 65 and those ups and downs are your monthly income, it's stressful. And so you're just better off, in my opinion, of saying, you know what, I'm not going to invest directly in real estate. And, I need one furnace goes bad and okay, well, there went my income for that property for the year, whereas you get a fixed rate vehicle and now you've got a more consistent, predictable income stream.
Gotcha. When they're retired, they're on a fixed income, right? So it's not very fixed if you've got, properties that are going to fluctuate in terms of their cash flow, unless you have a threshold. And this is where, why I recommend people, multifamily, because let's say your goal is to have $10,000 a month in income, for example, and your property brings in $20,000 a month, cash flowing, and it's an apartment building, of course, and so you've got that buffer there, so you're allowing for drops, ups and downs, but generally it's not going to go to 50% income, if it's a larger apartment building, right? So, but when you have a single family, I've experienced that where I've had, just one incident, like you said, something that goes bad, that a stolen air conditioner or something, and I've got to replace it, and boom, there goes my cash flow, and
right.
So that's true. But I think if you broad base it, or if you overshoot your mark in terms of your cash flow, then everything above that, let's say your goal is 10, you're shooting to get 20,000 in cash flow. All that is just extra, and you've got the buffer in there too. So I mean, just I don't know what you think about that.
Yeah, and I agree. And the way I look at it is, again, kind of a portfolio theory. If you're going to have 100 houses, on average, and when you look at a house, okay, here's what I should get in rent. Here's what my insurance and taxes are going to be. Those are fixed amounts that and here's about what I should expect in vacancy and maintenance and repairs. And here's all these estimates. And if you have 100 of them, over a period of a couple of years, those averages, those numbers should average out to be pretty accurate. Well, you don't own 100. If you own 3 or 4. Any given time, you may have, hey, the first 2 years we were above, we didn't have any vacancy and nothing went wrong. And then that third year, one of our 3 properties was vacant for 3 months, and we had a tenant turn cost of $2,000. And 3 months later, another one of our properties, the furnace went down. Well, those on a long-term average, you may still be at that a 9-10% return, but in that 1 year, your income is in trouble. And so that's why I just caution retirees about banking on the estimated return. But like you said, if that's enough to cover, if your estimate is 20,000 and you only need 10, you've got a lot of extra leeway there. You should be fine.
Right. That's I got it. Wow, that's good. Some really good stuff. Good advice. Now, your current business, what are your plans? What's exciting you about your business and where you want it to go in the next 10, 20 years down the road?
Right. Well, right now, we're improving a lot of neighborhoods by buying and rehabbing distressed properties. Sometimes we wholesale them to our investors, but a lot of times we're buying them and rehabbing them ourselves. And then we have a program where we help renters become homeowners. So I'm just excited that we get to make a living helping neighborhoods and individuals. So again, we're improving houses. We're placing people who want to be homeowners and are, for one reason or another, they can't get a bank loan right now, but they want to be a homeowner right now. And so we help them do that. And so that's very exciting for where we are. And as far as where we're going, we just want to continue doing that. And my goal for the next couple of years is to be able to do that for about 100 homes a year.
God, that's really exciting. That's great. And hey, I'll tell you, your work is definitely making a difference, because I have seen nothing but appreciation in the properties that I own there, and it's just been wonderful. Indianapolis is hot. It really is, and it just seems like it's getting better and better, and a lot of great stuff going on there. In the municipality as well. I mean, business coming in and a lot of incentives for business, and just a lot of things that are making it just a great city to do business, and for families and all kinds of great stuff. So I love that idea of looking at it more than just, hey, these are my financial goals. No, we're transforming communities, and that's really neat. That's the kind of stuff I think everybody should think of that's in real estate investing. That's great. We've kind of run a little bit longer than I told you, so I hope that's not. I hope I'm not going to crush any major appointments you got here. And you thought it wasn't enough information. Okay, we definitely got a lot of stuff here. This is great. And now we come up to what we call our wrap it up session, and this is we're asking you a series of quick questions, and you give me some quick replies so that you can share resources that have been valuable to you that could also be valuable to our listeners. So if you are ready, we can go ahead and wrap it up.
Okay.
All right. First question. Favorite real estate book?
The Millionaire Real Estate Investor by Gary Keller.
Yes, very good one. We featured that recently in our newsletter. Great.
Uh-huh.
Favorite business book?
I'm not sure if it's officially a business book, but I love The Richest Man in Babylon.
Yeah, I've heard that one before. Yes.
Just a simple cash flow, understanding how to get rich with cash flow. It's just simple and smart, and I wish I'd read it earlier.
I love it. How about your most valuable website for success other than your own?
Well, I say Zillow, and not because it's perfect, but because it can provide a thorough, reasonably accurate summary of a property in 30 seconds. I mean, if I just need, someone says, hey, I got this property at this address, I can type it in, and in 5 seconds, I'm looking at it, have a ballpark, roughly what it might be worth. Again, I'm not saying that's an exact science, but it gives me a ballpark. It gives me a ballpark of the rent information. So it's just a quick resource. It's very helpful.
Yeah, true. I think the Zestimate, or however they call it, is generally tends to be a little more generous than the real market, but it does give you good ballparks, and I think that's great. Awesome. How about favorite app?
Yeah, we use an app called Podio.
Yes, I'm familiar with that.
Yeah, it runs a lot of things within our business. It's incredibly customizable, almost too much. You have to know what you want, and then you can build it to do whatever you need it to. And it really helps with the systems in a business, being able to track everything.
That's great. How about favorite quote?
Growing up here in Indiana, anything related to basketball is always good. So, but my favorite quote is a John Wooden quote. When he was coaching UCLA, he said, "If you don't have time to do something right, when do you have time to do it again?"
I like that. I
love that quote. There's so many times I'm like, it's like, okay, I'm short on time. I'll just do this with this right now. Like, you know what? I'm going to be right back here in a day, a week, or whatever, having to do this again. Let me take the time to do it right. And so that thought, that quote just always is in the back of my mind.
That's one of my favorite, kind of along the same lines, and it was from the movie Hoosiers, with Gene Hackman was, stick to the fundamentals, Yep. And I'll tell you, in real estate, that is the truth. You learn them and stick to the fundamentals, you'll do fine. I love that Wooden one. Oh, that's great. That is so good. Our final here, this is kind of our big question here. If you lost everything you had, pretty much wiped out your accounts, and maybe you have a house to live in, but it probably you're kind of limited, you can't borrow against it, for example. All you have is $1,000 in cash. What would you do with that $1,000 to relaunch your real estate investing business?
Most people have probably heard of Ron LeGrand.
Yes.
An entire series, no money down house buying system. And that's exactly what I would do. And the irony is, I actually was at an event, and I won the door prize. And the door prize, and tells you how long ago it was the entire cassette tape collection.
Yeah. What was that? A cassette?
Yeah,
what is that?
Yeah. The cassette tape collection of his no money down system. And I won it, and I was excited, and I took it home, and I put it in a drawer, and it sat there for years. And I eventually pulled it out and started listening. I was like listening to it, and I couldn't believe, like, why did I not do this sooner? And so just some of the strategies in there, how to buy houses with no money down, and how to grow your real estate portfolio. Again, just great ideas. I wish I had paid attention to it sooner, even though I had it sitting right there in front of me.
Interesting. Now, is that did you use some of that when you started your wholesaling business?
Yes. Yeah. And I still use a lot of it today.
Great. That's great. I love it. Wow. Well, this has been such a great interview. I've just had a blast here. I love Indianapolis, but I think you've got just a wealth of information because of your broad-based background and your decades of experience here. Are you an old dog yet? Are you up to 50 years old yet? No?
I'm knocking on the door. Give me a year.
All right. Well, we'll give you a pass. It's okay. You're close enough, and your experience definitely puts you in the old dog category. But man, thank you so much, Steve. You've given some great information.
My pleasure. It's been fun.
Hey, I'm sure there's people listening too that want to know more about you and maybe even want to use your services. How can folks? What's the best way for folks to get a hold of you?
Sure. I'll share a couple things. I'd be happy to hear from you. Just give me a call. My phone number is area code 317-446-6026. And my email address is Indy, I-N-D-Y, Lawson, Lawson, @gmail.com.
Excellent.
my version of Indiana Jones, my last name is Lawson, so Indiana Lawson.
Indiana Lawson. I like that.
Yeah.
That's pretty cool. You have the hat, for all your photos,
Yeah.
That's great. I love it. Yeah, we got to get your marketing guys on that one. Okay.
That's right.
Wow. Well, thank you. Well, we're not done. We have one last thing we have to do here.
Yep.
That is our tradition. And
Yep.
I'm sure you can give us your best old Hoosier howl.
Hoosier.
So I'm going to let you go ahead and close us out today.
Arr.
I love it. That's great, Steve. Great. Oh, man. Super stuff here. Man, thank you so much for coming on. I really appreciate it. This has been
my
great
pleasure.
Show.
Good. Well, look forward to talking to you again soon.
Yeah, I'm sure we'll be talking real soon. So
all right.
I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note that everything we've talked about today here, including some of the links and some of the great resources that Steve presented, it all can be accessed in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog, and look for the episode with Steve Lawson. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.